Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, also with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for clicking on here and giving us a few minutes of your time for the April 21st Market Carver. Also, thank you for all those of you that came to our thirdly, either in person or in digital. Glad to have you, and once or twice or our twice a year event. Known as our thirdly season. So, Andrew, good to have you back as well after your well-earned week off. And Grant, as always, did a great job of filling in.
Oh, good. I'm glad Grant. I don't have. He's got big feet to fill my smaller shoes, so I no doubt he would do a good job. I can't say I was happy to come back and it snow the day after I got back from being in the sunny Florida weather. But hopefully that's beyond us and we can get back to spring weather, but it's good to be back.
Yeah, couldn't wait to be even more excited for some warmer weather. But we're going to be talking about several things here, switching into this week's topics. Three of them are related. We're going to take a deep dive into sentiment. We're going to talk about a survey known as the AAII. We'll look at consumer and small business, and then also look at bond markets. So sentiment in three different ways, and then we'll wrap up with energy costs. Before we go into sentiment, just a couple of comments or a warning, I'll say, is it's all going to sound very bad. It's not going to sound as if it's going to be presenting you what looks like a lot of poor sentiment, which is the case. A couple caveats to that. Number one is we've got to parse through different kind of time frames in terms of how long this type of sentiment reading should be thought of as impacting the landscape in front of us. And the other is sometimes poor sentiment can lead into positive or opportunities on the investment side. So that's kind of our job to distinguish when sentiment's gotten so bad to take advantage of. So starting off with the AAII, Andrew. So tell us what the AAII is and how concerned we should be about these readings.
Yeah, so this first one, AAII, stands for American Association of Individual Investors. So this isn't big hedge funds, this isn't pensions, this is kind of everyday American who's trading their portfolio. And we always want to know, whenever we're looking at any type of data set, we want to know, how is this data collected? Where are they getting this information? Is it credible? And so AAII is one of the larger, pretty well-known data sources for weekly investor sentiment. But something a lot of people probably don't know is, how do they get this data? What it is it's a collection of opinions from the people that are members to the American Association of Individual Investors. You can pay a fee, join their association, and start voting in their poll. But essentially what it is it's people who want their opinion heard. I'll tell you a worst case scenario: send Adam to downtown Indianapolis and start yelling, "Who wants to tell me your opinion?" Because that's pretty much what this is. They're essentially asking people, are you positive, are you bullish, or are you bearish on the stock market? And then they republish the results every month. And that's where we get this data you're looking at here, looking at the number of people that are bullish minus the number of people that are bearish. And what this is telling us is there's not a whole lot of people that are still bullish. You can see on the bottom panel of this chart, that is pretty low. It's actually the lowest reading since 2013. As we start seeing the stock market come down, we start seeing inflation data go up. People are seeing all the headlines about what's going on in Russia and Ukraine. Energy prices are going higher. There's a whole litany of things that we could point to that are causing people to be concerned. And thus, it's not a huge stretch of the imagination to imagine that sentiment's pretty low. And that's kind of the theme we're going to be talking through as we go through each of these charts. But this first one is looking at individual retail investors, and right now they're pretty bearish.
Gotcha. So we'll contrast that, which is the investment sentiment. So just a couple of clarifications, make sure I heard you right. And I know the answers, but I'm trying to unpack them in a meaningful way here. But if I hear you correctly, this is one piece of data that should get our attention. It gives us one clue as to where retail investors are, but we should pair that with other information, and especially the COT data that you use. So you maybe just touch on that a little bit and how we can paint the fullest picture we can on the sentiment before we would transact on it.
Yeah, I think if we were to take sentiment, all the sentiment sources we can get, you could put them in two buckets. You have people's opinions, and you have what people are actually doing with their dollars. And so I think those are two clear distinctions. This type of data, the AAII, this is telling you what people are thinking. It doesn't actually mean this is how they're actually positioning the portfolios. Someone very well could say, I'm really bearish on the market. And then you could ask them, well, how are you invested? And they can say, well, I'm fully invested in the S&P 500. Well, those are two different things. And so what we often look at and what we prefer as a priority source of data is to really look at how investors are positioned. And that's when we often talk about COT, commitment of traders. It actually looks at the futures market specifically and really gives us a clear insight into how individual investors, how pensions, hedge funds, actual users of commodities, when we talk about commodity markets, how they're positioned in different markets. And that's a much more telling form of sentiment than just purely someone's opinion versus their actual allocations in a portfolio.
Gotcha. Well said, as always. So sticking with the sentiment theme for the second of three times here, but we're going to pivot a little bit away from the stock market and look at the small business and the consumer, both of which are in bad shape here and meaningfully so. So if you could speak to a little bit about that from those two and where we've reached prior lows as well. It's a pretty long-term chart here.
Yeah, it is. This one's going back, you can see, going back to the late 70s. And this is combining two different, again, surveys of groups. So the first survey is done of small businesses. The reason that we often want to look at surveys of small businesses, they're a little bit more sensitive to changes in economic activity. Whereas a company like Amazon or Walmart, or they have a little bit more cushion to be absorbed, maybe some slowing down in economic activity or growth. Whereas small businesses are much more, like I said, sensitive to changes there in labor markets, and margin differences in pricing, things like that. So we want to see how are small businesses, what's the sentiment of small businesses, and we combine that then with the Consumer Confidence Index. Again, this is a much larger than the AAII. This is done by University of Michigan, and they take a polling, they phone people, similar to like how Gallup does their polling. That's a common one people are pretty familiar with. And they ask, how confident are you toward the market? Or not the market, but just the economy. And then they also ask people, what's your expectations about the future? And they take all this data and then determine kind of the Consumer Confidence Index. And combining these two, the result is pretty low. Small businesses aren't real encouraged, and the individual consumer doesn't have very high level of confidence. A lot of this is driven, again, by the rising costs of materials. Grocery bills are going up, energy costs going up, inflation has a big impact of this. But what's interesting is this data often also tracks the stock market. If we were to overlay the stock market on this chart, you'd see they're pretty highly correlated. And so it's interesting to see that confidence across small businesses and consumers is at one of the lowest levels really since the financial crisis, when we saw much lower levels within the stock market, which is right now only down about 8% compared to the financial crisis when we were in deep double-digit declines. So I think that we're seeing a more skittish consumer, a more skittish small business owner, as they are trying to respond to a lot of the news flow and a lot of the changing in price structure, as I think inflation is having a big impact here. Adam, what's your 2 cents on this type of data?
Yeah, well, number one, it's not a direct feed into our risk barometer, right? So we have bits and pieces of economic data that we feed into, but it's certainly a significant level here that leads us to believe that some of the economic data has been fairly strong, but that doesn't really matter. What matters is what direction is it going, and we continue to see stuff soften. I mean, there are bits and pieces that come in ahead of expectations, but for the most part, things are materially declining, and that sentiment's just not a good forward indicator. You need some sort of traction to be built on that. And I think really tying all that together, what is preventing, especially on the small business side, is people are basically aware that we've had a lifeline that's come out several times over the past 12 years from both the fiscal authorities and the monetary authorities. And everybody knows, I think, is on the same page that lifeline isn't going to come. So that's a negative feed into the sentiment as well, knowing that if things do get weak, they're unlikely to have that lifeline from the federal government or from the Fed to step back in anytime soon. So, want to take that for what it is and monitor the real data, but it's not a positive one for any sort of traction to reverse the slowness that we've seen. But again, it can turn around. Sentiment can be a fickle thing, and we will watch that accordingly. So the last of the three, as promised, on the sentiment side, looking at individual or looking at bonds, talking about a topic here that has just continued to escalate and get worse. I mean, we are, if you want to think about different environments in the financial crisis, bonds are having their 2008, when you just had a cascading group of losses that have just seemed to pile on top of each other. That is the bond market. Shared with you all in the thirdly how we have continued to see, we've seen one of the worst bond markets in history, as well as on the market cover. And this is just one other indication as well. And looking at the number of bonds that are trading at discounts, reaching a level that we've not seen since 1990. So another historical measure of just how bad that market has gone. Perhaps this is one of those more than the others that has reached a level that could be opportunistic, because you do have an actual instrument trading at a discount, but no investors yet stepping in to show some sort of diving in at the opportunity. So Andrew, anything that you'd added on the bond side? We've kind of hammered sentiment home.
Yeah, I think kind of the main takeaway here, it can be two different things. Yes, sentiment is very low across equity markets, consumer confidence, small businesses, like you just covered on the bond side, that bonds have had a pretty steep decline based on historically. And I think some of that, like you said, it can be concerning. The other takeaway is kind of also the point you just made about how this can create opportunity. When you have sentiment at very low levels, there's things that can be potentially oversold, thrown out kind of with the bathwater, so to speak, to where as investors, we can find maybe things that are opportunistically attractive at this point. This provides kind of what often gets described as a stock picker's market, so where there's certain stocks that maybe are doing well or can start to rebound during these poor sentiment levels. Opportunities in fixed income that Adam always does a great job with, finding opportunities there that maybe, because we are looking longer term, that maybe present an opportunity in the next couple of years where we can maybe find attractive pricing today. So while sentiment, yes, is very low, that can create opportunities if you know the right places to look. And that's something that our team is constantly doing, trying to uncover those opportunities that we feel like is a good fit for our portfolios and makes the most sense from a risk perspective. And so we're always looking for those opportunities when sentiment's really, really low. So we don't want to take it too much of a negative viewpoint here. Yes, it's concerning when sentiment's really low, but it maybe presents some good opportunities as well.
Yes, yeah. And the good news here is that we've shared the message earlier this year when we did the same thing in 2020. It was a twin message that, at least from my seat, I had not seen a more toxic environment or more toxic setup for bonds in my entire career. Now that was during a mostly a very long bull market in bonds, but I'd still not seen a more toxic setup in bonds. I can no longer say that's the case. We have a much different setup. It doesn't mean that we have a good long-term horizon for bonds, nothing of that nature, but no longer quite the toxic scenario, right? There is some value creeping up in some corners of the bond market. That doesn't mean, again, that we want to take our positions to an overweight. But we've been very, very defensive because of that toxic outlook. And as things have shot up here and as everybody else is catching up to a poor sentiment, it's creating opportunity, and we're becoming less and less defensive all the time as we take advantage of some of those opportunities. And lastly, I would put this more on the positive side, is looking at energy costs. Energy is one of the things that's made this a difficult environment. Obviously, the energy cost, particularly to the lower end of consumer, but we're going to focus in on the right panel of this chart, and it's looking at the various sources of energy from a long-term perspective. And the blue is going to be solar, and then we also have wind in there as well. And both of those have fallen well underneath the cost of coal and even natural gas, which became a big focus in the 2010s as we uncovered lots and lots of natural gas here in the United States. Solar costs have just collapsed and have actually undercut wind and become even a cheaper source of that. So those are two great things. Of course, it took a lot of investment to get there, but we are at a couple of pivot points, and that can be great for this. And we've seen a lot of utilities, some of which we have in our portfolio, be able to invest in these energy sources, which have a nice long runway because of their low cost of production at this point in time. So I think that's a good wrap for this week's Market Carver. Appreciate all the time that you've given us and watched. Don't forget that you have a chance to watch our radio show. And also don't forget your weekly opportunity to schedule a meeting. Give us a call, 800-928-4001, or scan the QR code, or catch the radio show on over the airwaves, WIBC, or through podcast form. And please have a great weekend.